In this video, I'm going to cover Chapter 5, and I'm going to specifically be looking at indexes, or indices as they're called. Either word applies. And I'm going to be looking specifically at price-weighted indexes, value-weighted indexes, which are by far the two most popular. We'll also look for comparative purposes at equal weighted indexes, EWI. Now, in order to make the material here more concrete, I made up an example. And so here we have, we're going to have an index. We're going to assume that the index is made up of just 3 stocks. I mean, in reality, indexes are, made up of, it could be made up of hundreds, if not thousands of stocks, and we're not going to go through all those calculations. We want to get the intuition, and that's the purpose of this video, get the intuition of index construction and what indexes mean. So we have, in this example, 3 stocks, A, B, and C, and the price at time t, you can think of it as today, as being $25 for A, $150 for B, and $70 per share for C. And at PT plus 1, think of it as, time t plus 1 year. It could be 1 month, but it's just one extra tick in time. And so we got 30, 120, and $70 per share. The quantity, the number of shares outstanding, and that's what Q stands for, is there's 1,000 shares of A, there's only 100 shares of B, and 500 shares of C. Okay. So now the first thing we want to do is we want to look at price-weighted index. An example of a price-weighted index is the Dow Jones Industrial Average, and and other Dow Jones averages like the Transportation Index and the Dow Jones Utility Index. They're all price-weighted indexes, and price-weighted indexes are by far the most easiest to calculate. It's what Charles Dow put together in the 1800s when he wanted to put together a stock index. All he had basically was pencil and paper. He didn't have a calculator or a computer, so he put it together relatively easily by just adding up stock prices and dividing by the number of stocks. That's basically what a price-weighted index is. And like I said, the Dow Jones Industrial Average is a price-weighted index. It's probably the most popular index out there. So the way we calculate a price-weighted index is we're going to take the sum of the prices of the stocks in the index. So it could be from I equals 1 to, if it was the Dow Jones, it would be 30 stocks. So you say 1 to 30. And so we're going to sum from I, individual stocks going 1 to 30, sum of those PIs, and we're going to divide by D, a divisor. Now normally I would divide by N, meaning N equals the number of stocks, but I'm going to explain to you why we don't use the letter N and why we don't use the number of stocks in the index to divide by. You only do that. You only divide by N, the number of stocks in the index, at the very first time you're computing it. And subsequently there may very well be issues involved in dividing by N. So I'll call it for now D, a divisor, and I'll explain later why in more detail what's going on here. So in terms of our example, we can calculate the price-weighted index as being, for period T, the price-weighted index is 25 plus 150 plus 70. Those are the share prices, divided by 3, and we get an index of 8167. Okay, not so bad. We do the same thing at T plus 1. And so we're going to take the 30 plus 120 plus 70, divided by 3, and we get 73.3. And we say, look at that. The stock market has dropped, right? That's what it looks like. The stock market has dropped, and you look at here and let's say, let's see. Well, stock A, it went up $5, but stock B dropped 30. C stayed the same. So really, it's this stock B really had a big influence on the index itself. And so the stock market as a whole went down. Okay, that's basically a price-weighted index. Now, what you see here is that with a price-weighted index, literally read it off, which stocks get the most weight in an index? Well, the stocks that get the most weight depend on the price. Stocks with the highest price get the most weight, and I'll explain that in a little bit, but you're starting to see it right here with this high price stock. Okay, because look, 25 to 30 is a 20% increase. 150 to 120 is a 20% decrease. They didn't offset each other according to this index. The high price stock had the bigger influence on this index. Okay? And I'll get into that a little bit more once we look at value weighted indexes and compare and contrast. Now, with a value weighted index, the math it's a little uglier, and it is the sum, and I'm going to use the S&P 500 symbolically here as an example. The S&P is an example of a value weighted index. Nearly all indexes today are value weighted or some function of a value weighted index. And so if you look at the S&P 500, it has 500 individual stocks. So you start from 1 to 500. And what are you going to sum? What are we going to sum? We're going to sum the value of the companies. And the values of the companies are its market caps. Market capitalization is the price of stock I times the number of shares of stock I. So what we're doing here is we'll this PQ for each stock is the value, the market value of the company. And we're going to do this. We're going to add up 500 of these across the top. Okay, for the S&P is 500 across the top. And then you see why computers come in handy with stock indexes. So that's the numerator. The denominator is going to be similar calculation. And I'm going to put a little b here. You could put a little t here if you wanted up top at time t. But here, let me explain here. The bottom part of the fraction says, look, we're going to take the market caps of all 500 stocks and add them up, just like we did above. But we're taking this price and the quantity at some base period, some historic point in time. And we're going to compare the market caps of all 500 stocks today. You can think of time t as being today, versus what it looked like at some base period. So, you know, if this turns out to be 10,000, or let's say it's 11,000, when you take the price, chop off a bunch of zeros for the S&P, let's say it's 11 trillion, and you divide it by some base period, and it was 10 trillion at some base period, basically you've got, and you can see that there's a 10% gain here in the index. So you have basically what you're looking at is the price component of total return for these 500 stocks. It shows a 10% return. Okay, so I'll say it again. The indexes, as we see them here, with a price-weighted or a value-weighted index, is capturing only the capital gain or loss component of the underlying stocks. It's not capturing the total return component. It's ignoring dividends. You see here, there's no div in the calculations here for price weighted. There's a D, but that's for divisor. But there's no dividends calculated anywhere here. We're only looking at prices, and then with the value weighted, we're looking at price and quantity of the number of shares outstanding. So let's actually apply this formula to the example I gave you. Now, I'm going to tell you that when you start a value-weighted index, when you start the value-weighted index at time t, the index is always going to be, put a little colon here, it's always going to be 100. And it's set up and designed that way. Because what we're going to do is, I'll show you, just to prove it to you. We're going to take, at the base period, we're going to calculate. We're going to assume time t is the base period. Base. And so let's calculate the index at the base period. So we're going to take 25 times 100, 150 times 1,000. 150 times 100. And when I do this calculation, the value weighted index, now I'm calculating a value weighted index. The value weighted index, when you very first start an index at the base period, at time t in this example, the index starts out at 100 because the top part is equal to the bottom part. So this whole component right here is a 1. It's always that case. It's 1.0 when you first start an index. And you multiply it by 100 to get so your index starts out at a nice round number, which is very convenient. Now, that said, I kind of left it out here in this formula, so you might want to go back in this formula here, and we could multiply this whole thing by 100 right here in the formula. So it starts out at a nice round number, and this would end up being 110, just to complete that example earlier. So multiply this by 100, and boom, base period is always 100. So when you get a problem like this and you want to know what is the value of the index at the base period, you don't have to do any calculations. It's 100. Now, at the next time period, there's going to have to be some calculations because you're one step ahead in time. So you're going to have to do the calculations. You're going to need to ask yourself, what is the market value of the index at time t plus 1? Well, it's $30 times 1,000 shares plus $120 times 100 shares plus $70 times 500 shares divided by the base. Times 100. And so when we do that, we get 102.67. So the index in this problem went from 100 to 102 for a 2.67% gain. Now, which is it? I just told you it went up 2.67, but I told you a few minutes ago, according to the price-weighted index, the market fell. So in this, rather contrived example, and I'll show you a contrived example in class also around this, you got a conflicting story as to which one went up. Well, you need to ask yourself, which is the more relevant index? Both were physically, mathematically, I both calculated them correctly, but which is the more relevant, more economically intuitive index? And it turns out to be the value-weighted index turns out to be more intuitive because we're looking at market capitalization and the values of the firms, which are important. And so you can look at those values of the firms, being the P times the Q, those market caps, as representing the value of the overall economy. So, bear with me here. Think about this for a second. If you assume that the S&P 500 is a benchmark index, and you assume that it represents the value of the economy, big leap, but use your imagination a bit. Say the S&P 500 represents the value of the U.S. economy. You would want to know whether or not that value has gone up or gone down over time, and that's what a value-weighted index will tell you. A price-weighted index like the Dow Jones Industrial Average will not tell you that because all it deals with is price. It doesn't look at the size of the company. It's only looking at the size of the price. Price by itself tells you almost nothing. I say almost because, if you see a penny stock, that price is telling you something. but when you look at a stock that's 20 versus 25 or 100 or $1,000, that price, the information content from that price is almost useless because you don't know how many shares are outstanding. If a company decides to issue a lot of shares, well, the price will be lower than if a company only decides to issue a few shares. So value-weighted indexes are far more valuable to people in finance and to economists trying to measure and gauge the value of an economy, or at least the underlying companies in the economy. Now, one of the good things about value-weighted indexes is when there is a stock split, the number of shares adjusts and the price adjusts also. So if you have a 2-for-1 split, a price will chop in half, but the number of shares outstanding will double. The market cap of a stock remains unchanged, which makes sense because a stock split is nothing but an accounting gimmick, right? It's just making the shares more accessible to the average investor. So they split the stock price and half of it, or they could make it a 3-for-1 and divide it up into 3 pieces, equal values, and so on. So a stock split has no implication on market cap, and so it doesn't affect these value-weighted indexes. But a split will influence a price-weighted index. So what do they do now? When you have what do we do when we have a price-weighted index? What does Dow Jones and Company do? Well, let me show you. First of all, when a stock splits, it doesn't really have any, like I said a minute ago, it has no implication to a company in reality in terms of its value. And so you don't want a stock index to pick up on stock splits. And so we can do that by recalculating a divisor. So when we did the price-weighted index a couple minutes ago, we had 25, we had 150, we had 70, and we divided by 3 because we had 3 stocks in the index, and we came up with 81.67. That was the value of our index. Now let's assume right after we calculate this index, after the market closes, let's assume that there's a 2-for-1 split in stock B. 2-for-1 stock B. So now let's recalculate the divisor, keeping the index unchanged because we don't want the index to change every time there's a stock split because it doesn't have any economic, there's no economic value to a stock split. So we're going to put in 25. Stock A remains unchanged. Stock B is now worth 75 on a 2-for-1 split. Stock C is unchanged at 70. We're going to figure out what D is going to be. We're going to have a new divisor because we want this to remain at 81.67. So when we do this, we cross multiply, set them equal like we did before. And D now equals 2.08, which is below what it was at 3. And so when you have stock splits, your divisor is going to drop off. Now, over time, your divisor in a price-weighted index is going to change anyway. It's going to change for a couple of reasons. There's going to be stock splits. There could be large accounting stock dividends. There often is stocks that are coming in and out of the index. I mean, think about it. If the Dow Jones Industrial Average started out in the 1800s, none of the stocks that you see today are there, except I think General Electric is the only one that's been in the index the whole time. So you have stocks, for example, you know, the index was heavy on railroads and utilities and steel back in those days. A lot of that has gone out. The economy is far more diverse. There's now, you know, Microsoft and Disney and companies that didn't exist in the 1800s that are in the Dow Jones. The Dow Jones Industrial Average is made up of 30 stocks, and they're 30 blue chip stocks, and they're supposed to represent the diverse blue chip economy. So what the stocks you see in the Dow Jones Industrial Average typically, nearly all of them you will know. They'll be household names. Now, you can't say that, obviously, with the S&P 500. Once you get past the first couple of them, you may not recognize most of them in terms of names. So, to reiterate now, price-weighted indexes have a divisor. The divisor will change as stocks come in and out of the index. So you want the index to remain unchanged when you swap stocks in and out of the index. So you're going to have to change the divisor. When there's a stock split, you're going to leave the index the same, and you're going to change the divisor. And so over time, the divisor changes, and you can see that. Go to the Wall Street Journal. I hope you can see this, but this is a Wall Street Journal. I'll zoom in for you as best I can. So here's the Dow Jones Industrial Average Index. You know, it talks here, the index was down 220 points for the day, and it's telling you the trailing PE, which is price divided by last year's earnings. It's telling you the leading PE, which is price divided by an estimate of next year's earnings. It's showing you, I kind of marked over it, the dividend yield, which is around 2.07%. So the Dow Jones Industrial Average throws off about 2% in dividends per year. And here is the divisor. Now, you might have to look at it really closely. I zoomed in as far as I can go. But the divisor, I'll write it out. It's well, first of all, it's about 10 decimals. But it's 0.1557. Far below what it would be if we were dividing by 30. So it's much below at 0.1557. Now go over to the S&P 500. Here's the S&P 500. Notice it has all the same information with the S&P 500, right? But there's no dividend. There's no divisor because the S&P is a value-weighted index. There's no divisor. But for the Dow Jones averages, not just this one, not just the industrial, but the transportation index and the utility average. And if you come down here, you'll see, for example, here's major stock indexes. You see Dow Jones average, industrial average, transportation, utility. These guys have divisors. But nearly all other indexes will not have a divisor because most other indexes are value-weighted indexes. Now, that said, there are equal weighted indexes. And that's the third index that I want to cover. And let me kind of zoom back out of here because I'm a little too close up on things here. Okay, so now I want to cover equal weighted index. Equal weighted indexes are indexes where you have an equal amount, equal value in each stock. So when you have 3 stocks in an index, you have equal weights. And the way to calculate it, to set it up so it equals 100, the formula will look like this. 1 over n, which is the number of stocks in the index. And we're going to say price of A at t plus 1 divided by the price of A at t, this relative price ratio, plus P of B at time 1, time t plus 1, plus divided by the price of B at time t, plus the price of C at t plus 1 divided by the price of C at time t, times 100. Now, before your eyes glaze over looking at this, this looks messy, but it's really not. So if we calculate this at the base period at time t, let's calculate it at the base times t. We basically have 1/3. We got 1 over 3 stocks, and we're going to have a price of 25 because we're calculating the base right now. So all we have is time t. So it's 25 over 25 plus 150 over 150 plus 70 over 70 times 100. That whole thing equals 100. because this is the whole thing in big bracket is 3 divided by 3 is 1 times 100. The index starts out at the nice round number of 100. Great. Now let's look at t plus 1. We'll calculate the index. So it's 1 over 3 Ooh, look at this. When we calculate the equal weighted index is unchanged. It stayed at 100. Look what happened here. This stock went up 20%. Stock A went up 20%. But B went down 20%. So this is 1.2, this is 1.8. Stock C remains the same, so inside the big bracket is still 1. Basically, A and B offset each other because they each had a 20% return, but one was positive and one was negative. They offset each other. Divide by 3, and you get an index of 100. So with an equal weighted index, you see that one offset the other, and which is kind of cool watching this example unfold. So with a price weighted index, we saw that the index dropped. And that's because the stock with the highest price fell by 20%. Then we looked at a value-weighted index, and we saw that the value-weighted index increased. Let's see if I can find my notes on that. The value-weighted index went up a bit. Why did it go up? Because the stock with the highest capitalization increased. Stock A has a high market capitalization. Look, this capitalization is $30,000 at this point, or $25,000 if you look at it up here, right? That stock increased. The stock that was not worth very much but had a high price, but its cap was not worth very much, that stock went down. Okay, and that's what. And so, even though there was a big price drop for B, it wasn't worth and wasn't much to the economy. It was this big stock with the 20% move that caused this index to go up a little bit. Okay? And then when we saw with the equal weighted, we saw that, you know, each stock, if we put an equal weight in each stock, then there's no effect, because one will completely offset the other. So now the last thing I want to cover in this presentation, well, two things. One, many value-weighted indexes now are being managed by hand a bit. What I mean by that is there tends to be stocks within the index that gets out of hand. And a good example is the NASDAQ 100 has 100 stocks in it. So you would think, okay, it has 100 stocks, then the typical stock should be, or the average stock should have be worth about 1% of the index. But you know, yes, the NASDAQ is a value-weighted index, so some of them are going to be worth more than 1%. And have more than value of 1%, and some of them are going to have less than 1%, but it'll average out to maybe 1%. Conceptually, think of it that way. Okay. But what happened is, in the past, occasionally there is a stock that gets out of control. It goes up tremendously, and an example would be Apple. Back a few years back, Apple stock shot up dramatically, and it was a significant part of the index, too much weight. And so what the people who controlled the index, the NASDAQ people, they chopped off some of the weight that Apple had in the index. And when you chop off some of the weight has to add up to 1. They had to throw more weight on the other stocks. That's called a managed index. And it's typically with value-weighted indexes, smaller ones where, you know, a particular stock could have an influence on it. Now, the last thing I want to talk about is how do you actually replicate a price-weighted index? How do you replicate a value-weighted index? And how do you replicate an equal-weighted index? Now, what do I mean by replicate? Well, I mean, okay, you got money in stock track, and you wanted to devise your own Dow Jones average. Okay, you wanted to set some money aside and have it mimic the Dow Jones Industrial Average. What should you do? How should you form that portfolio? Should you put an equal dollar amount in that portfolio? Should you put an equal number of shares in that portfolio? Or some other mix? How do you do it? How do you go about getting a price-weighted index? Well, it turns out if you want to mimic a price-weighted index, you need to have an equal number of shares. Equal number of shares in each stock. So in this case, you'd have, let's see if I can do it here. So you'd have 25 times Q plus, Q could be, let's say you buy 10 shares, and you have 150 times Q, so that'll be 10 shares, and you'll have 70 Q, and that'll be 10 shares. The Q kind of pulls out. This 10 shares pulls out, and you get 25 plus 150 plus 70. And so all you need to do is invest in an equal number of shares, and so you take the sum of the prices. Now here's basically the price weighted, the index itself here, and then you're going to multiply it by a scalar by basically the number of shares that you want to buy in each of the individual stocks in the index. You can experiment with that, and I have problems like this in the homework assignment. It takes a lot of calculations. It's a little intensive in terms of the computations, and so I'm not going to do it here, but you can see it in a homework problem all laid out. So if you want to mimic the Dow Jones Industrial Average or a price-weighted index, you're going to buy an equal number of shares, Q, to invest in. And if you wanted to mimic a value-weighted index, you're going to have to buy the number of shares in each stock is going to be proportional to the value of that individual stock relative to the value of the entire index itself. And so that's how you would invest in a value-weighted index. It's all based on the relative market caps. It's all proportional. In an equal weighted index, you're going to have to invest in an equal amount of each stock, equal dollar amount of each stock. There are very few equal weighted indexes out there because they're a nightmare to manage. And the reason is, when you think about it, right now you put together an equal weighted index, you invest, let's say, $30,000 in each stock, which is the price times the quantity of shares, and you figure out how many shares to get of each one, so you invest an equal amount. Well, 5 minutes, even less than 2 seconds after you put together this whole portfolio, the weights are going to be different. Some stocks will have gone up in price, some will have gone down, and you won't have an equal weighted index anymore. So what you're forced to do, if you really want to keep an equal weighted index, you have to rebalance. And you're going to have to rebalance continuously as the markets open, which means you're going to have gigantic expenses managing an equal weighted index, because you're going to constantly buy and sell. You're going to have bid-ask spreads that you're going to be facing. You're going to have commissions, and it's going to be one big headache. So what people do in the real world is they say, well, we'll manage an equal weighted index, but we'll rebalance once a week, or we'll rebalance once a month, or we'll rebalance once a year. And so they put constraints on the rebalancing to minimize the amount of transaction effects and to make it doable. So, but nevertheless, equal weighted indexes are not that popular. Occasionally the Wall Street Journal, just to give you insight into what how value weighted indexes can sometimes be distort what happens, and they show you what happens if you use an equal weighted index. That's information that's valuable, and it's often discussed in the Wall Street Journal, especially with the S&P 500. But by and large, most indexes are value weighted.